own brother.
Something spooky this way comes. I hope you're watching this video in time because tomorrow, Friday, March the 21st, is a very, very big day in the world's largest casino. I'm talking about the stock market, and I'm talking about quadruple witching. If you don't know what that is, don't worry, I'll be explaining it in this video, but what you need to know, the TLDR, is it's associated with very high levels of volatility, on top of the fact that the market is already in a very volatile state, so man oh man, are there some tendies to be made if you're on the right side of the trade. So we have a lot to talk about, we have a lot to break down. Of course, if you enjoy these type of market discussions and breakdowns, don't forget to like, don't forget to subscribe. And with that being said, let's rock. Now, to have a better idea of where we might potentially be going, you should have an understanding of where we're coming from. Here was the official headline when the casino closed today. S&P 500 closes lower today, Thursday, as Wall Street's comeback attempt falters. And if you look at the heat map of the S&P 500, it is exactly that. A little bit of green, little bit of red, a lot of gray, and a lot of indecisiveness in the market. When we woke up today, the market in pre-market trading was absolutely diving. Then right at market open, both the S&P 500 and the Nasdaq exploded, and then around 10:45, we kind of just drifted down for the remainder of the day, which officially means that the SPY closed in the red by about 0.3%, and same thing with the Qs. I also want to point out that even though we were in the red, volatility also dropped a little bit. Granted, just barely red, but I think it's worthwhile to point out. So what happened here between yesterday and the overnight session that led to a little bit of craziness today, and we are definitely going to get way more chaos tomorrow? Well, yesterday was a big day. We got the FOMC decision, the Fed interest rate decision. Fed projections see an economy dramatically reset by Trump's election. Not long ago, Federal Reserve officials presumed that 2025 would simply be about getting to the soft landing. Man, oh man, did they miss the mark on that one. Fed holds rates steady, sees slower growth and higher inflation. That was the giant headline of the decision that we got at 2 p.m. yesterday, and then Jerome Powell took the stage at 2:30 and he brought back his favorite word: transitory. Transitory is back as the Fed doesn't expect tariffs to have long-lasting inflation impacts. I know there's a lot of just fancy schmancy monetary, economic words and jargon in here, but what you need to know is the Fed didn't change rates. We came in at 4.25% yesterday. We left at 4.25% yesterday. And as I'm about to show you, we're not even going to be getting a rate cut until June, so don't be holding your breath on that. But right now, that is not making the administration happy. Trump says Fed should cut rates as tariff push heats up, and he actually was a lot more colorful in his own wording. The Fed would much be better cutting rates as U.S. tariffs start to transition, ease their way to the economy. Do the right thing. April 2nd is a Liberation Day in America. As you can see, this was posted after the market had closed. In fact, it was posted at 10:10 Eastern. And this colorful update, if you will, added to a lot of the confusion and already clear amounts of uncertainty. And that's why in pre-market trading, we started to dive because everyone's like, what's going on? And I want to clarify, yes, we were already in very high levels of uncertainty. This is the summary of economic projections. It's a super nerdy economic report that comes out every other FOMC meeting. And I don't want to bore you to death, but what you need to know is the Fed is willfully admitting that they expect things to get worse. Back in December, they thought the GDP was going to be 2.1 for the year. They dropped that to 1.7. Unemployment, they thought it was going to be 4.3. They're jacking it up to 4.4. The inflation report, they thought was going to be 2.5. They're jacking that up to 2.7. As in, they think the economy's going down, unemployment's going up, inflation's going up, and yet they're telling us that we're still going to get the same amount of rate cuts. Obviously, that's causing everyone who's actively trading and paying attention to scratch their head. They think the whole situation's going to get worse, but yet they're going to be able to still do the same amount of rate cuts. So that's interesting. And on top of it, the other piece of news is that they are kind of admitting that it's getting a little bit rough because they are dramatically bringing down the aggression of their QT, aka their quantitative tightening. If you want to look that up, feel free to do it, but you have to know their aggression in really running off their balance sheet, not going to be so aggressive. This does bring us to the state where in the May meeting, May 7th, it's looking like we're not going to be getting a rate cut. In fact, we're at 4.25%. There's an 83% chance that we're at 4.25% after the May meeting, and the odds first time they really jump up for getting a rate cut is in the June meeting, once again, June 18th, and there's more than a 50% shot that by then we're actually going to be getting a rate cut. This is the whole backdrop of what happened yesterday, what played out through today, and that's setting us up for tomorrow, where as of now, there's no scheduled major macroeconomic events in terms of data drops, but we are going to be getting something exciting. It's referred to as quadruple witching. Stocks halt the Fed-fueled rally as trade fears linger. A 4.5 trillion, not million, not billion, trillion triple witching gives investors another test. So what is the deal? What is quadruple witching? Well, it happens to be one of my favorite trading days of the year, and we get 4 of them. And here's what it is. At the end of every single quarter, you have 4 types of derivative contracts, all the types of derivative contracts, expiring. You have stocks index options, stock index futures, and then you have single stock options and single stock futures. Now you might be thinking, why do you keep saying quadruple witching where right now Bloomberg, the lamestream media, is saying triple witching? It's because that last one, the single stock futures, that's really not a popular derivative for anyone to trade anymore. So some people call it triple witching. I call it quadruple witching because they technically are still expiring, but whatever. You get the point. There's a consensus. There's an alignment of many different types of derivative contracts all expiring on the same day, which means a lot of decisions need to be made. Are they going to buy again? Are they going to roll? Are they going to lock in their winners, their losers? Decisions need to be made between institutions and traders, especially in the final hour, which is actually nicknamed the witching hour. So what you need to know is this is not a bullish event or a bearish event. Of course, it could be bullish or it could be bearish, but it just means expect a lot of trading, a lot of volume, and a lot of volatility on top of a situation where coming into this, there's already a lot of trading volume and volatility. And now this leads me to the prediction part of the video. Obviously, everything up to here was cold hard facts, and now let's just see if we can make some educated guesses. On the screen right now is not only the price action, the white line of the S&P 500 throughout the day, but you also see the options flow, as in the delta reading, very strong up until around 10:30, and then the options flow just down and down and down until the end of the day. So we went from bullish to bearish in the options market, and it's all happening around a really, really interesting level. If you bring up SPX, not only are you going to see we try to break out on Monday, we try to break out Wednesday, we try to break out today, smacked, but the truly interesting thing going on is that the central point, which happens to be around 5,650. Remember that market, do whatever you need to, but this line, let me clean this up just so it's not as confusing. We are very much trading around this point, and it is for good reason. 5,650 in the S&P 500 index in terms of close strikes happens to be the most important open interest level. So what I'm saying is if we can clearly hold this level, I think there's actually a legitimate chance of kind of breaking this wicking formation and going higher. On the flip side, if we go below that, I think something pretty crazy could happen to the downside, especially if we snap 5,600. I'm talking we might be revisiting these recent lows. But my point is that the line in the sand is 5,650. And for those of you trading the SPY, the actual ETF, that's closer to like about 564.50 is like roughly that level. But once again, that is the line in the sand heading into quadruple witching. So if we see a nice base and domination above that, this actually might be a nice launch pad to legitimately go higher. But on the flip side, if the market doesn't want to hold that value, if we're seeing calls being sold and puts being purchased and we crack that, well, maybe we catch ourselves at the recent low from Tuesday, but I think that there are greater odds than not that we might be revisiting this zone down here. So obviously, pay attention to quadruple witching, pay attention to the options flow, and very, very important to pay attention to that equilibrium line. I would say bullish above it, bearish below it, and obviously, good luck. Clearly, if you have any questions, comments, concerns, let me know in a comment below. Other than that, I'm going to be streaming this entire event. So from Monday to Friday, 9 to 11, we're doing the show anyway, where I'm degenerately trading my own money. But if you want to stop by for that fun tomorrow, to have a little bit of quad witching fun, I will be there once again, half hour before the market opens. I appreciate your time. I appreciate the good vibes. I'll catch you in the next one.